Hi, and welcome back for another episode of Just for Funds. Today, I'm here with Michael Mack, Client Portfolio Manager at Victory Capital. It's great to have you here today.
Thanks, Gabby. Glad to be here.
It's always great to have Victory Capital in the studio. Can you tell us what's new with your business and then what's new with your VictoryShares ETF platform?
Yeah, it's an exciting time at Victory Capital. We recently announced the addition of our newest investment franchise, Pioneer Investments, formerly Amundi US. A lot of our clients know them as the home of the second oldest mutual fund, the Pioneer Fund. They were also a leader and an early adopter of the concept we know today as value investing. And so they have a long history of investment excellence. And so we're really excited to have this storied franchise under the Victory Capital umbrella. In conjunction with that, we rolled out our first Pioneer active ETF, the VictoryShares Pioneer Asset-Based Income ETF, ABI, which leverages the firm's fixed income expertise, targeting the securitized credit market. And it really represents an opportunity for investors to expand their fixed income portfolio to an exciting segment of the fixed income market. Alongside ABI, we've also rolled out two new international free cash flow focused ETFs. And really this represents an expansion of our current free cash flow suite, right? We've hit a lot of momentum in that series, and it's an interesting time as we sit here today in our ETF business, right? As of most recent quarter in June 2025, our ETF platform hit $15 billion in assets. And so we think this is a testament to, one, the investment excellence our investment teams are able to deliver. But number two, it really represents the firm's commitment to innovation in the ETF marketplace.
Excitingly, you have two new Nasdaq listed funds, IFLO, the VictoryShares International Free Cash Flow Fund, and then the VictoryShares International Free Cash Flow Growth Fund, GRIN. Can you tell us a little bit more about what's resonating with advisors with these funds and how they might be considered when building out client portfolios?
Yeah, when we think of our ETF platform, you can kind of split it into two segments. On the active ETF side, what we're seeing is our investment franchises have been able to gain momentum in that space, right? Investors are increasingly looking to adopt active ETFs. And so there's been a lot of traction and momentum on that side of the platform. The other area we've seen success is on the rules-based side, where what we've been able to do is take an existing concept in the marketplace today and improve upon it. One area we've seen this is the value momentum indexes. So for a lot of investors, they're looking to get exposure to value ETFs and they're looking to get exposure to momentum. What can happen is if you take a value ETF and combine it with a momentum ETF, those factor exposures can cancel each other out and your portfolio can be left without its intended factor exposures. Where the value momentum indexes come into play is they take those factors and combine them inside one ETF, and they measure them from a bottom-up perspective, which will ultimately attempt to provide exposure to both the value and momentum factors that investors have intended. The other area we've seen momentum in is in our free cash flow suite, where we've taken the concept of free cash flow and improved upon it by taking a more forward-looking approach in terms of the index design. And that's what we see with these new products. They really represent an expansion of that, where in today's market, clients are looking to diversify, where maybe in the past they've been underweight international. A lot of clients we speak with today are looking to close that gap. And to do that, they're looking to high quality, high free cash flow generating companies outside the United States.
Let's dive into that a little bit more. The Victory US Large Cap Free Cash Flow Index captures companies with high free cash flow yield. How's it different and what problems does it solve in the investing world?
I think if we take a step back and consider, why does an investor want to consider free cash flow? And it's really, at the end of the day, the value of a company. It's the present value of the future free cash flow. So we think it's important that investors align their strategies with what ultimately determines a company's value, and that's free cash flow. The other reason we think free cash flow is important in today's market is how do you measure value in 2025, right? Where we've seen value strategies struggle recently is that if you look at your traditional value indexes, they have been defining value as metrics by like price to book. The challenges price to book has faced in this economy is it's going to value a company based on their assets. Well, today, where is the company's value in their assets? They're intangible assets. They're driven by factors like patents, R&D. And so what's happening is it's being increasingly hard to capture of the value of a company's assets. And so if you're trying to determine a company's value based on that, it becomes challenging. The solution is to look at a company's free cash flow, where you don't consider a company's assets, right? You look at their cash flows. And free cash flow over the past 25 years, it's been successful at identifying value across a wider array of sectors, in particular, places like technology and healthcare, some of the growth sides of the economy, where your traditional value approach has tended to have a blind spot because of the challenges with traditional accounting metrics. The second part of this suite that's important to understand is kind of how are our indexes designed. And our indexes they're really designed to measure free cash flow from a forward-looking perspective. So the index is going to consider not just the company's trailing free cash flow, the last 12 months. It's also going to look at the next 12-month free cash flow based on the consensus analyst estimates. What that's going to do is give you a forward-looking measure. It's also going to give you 2 years of data to provide a more comprehensive measure of a company's free cash flow. And if you think about why the index would want to do something like this, it's the idea that you can have these companies where they've been very profitable in the past. So if you look at their trailing free cash flows, they appear profitable, but maybe there's an obvious trend in the market where they're no longer expected to be as profitable going forward. This measure, right, the combination of forward and trailing can help you potentially avoid some of those pitfalls. The last thing to consider when looking at free cash flow is the growth rates of those companies. Where free cash flow you can run into trouble is if it's constantly allocated to companies that aren't growing, right? And so it's important to consider a growth filter where you're going to eliminate those slowest growers, right, as a way to enhance your value process. So still value, just avoiding value through those slow growers. Over time, that has the potential to produce better and more consistent results for investors.
So moving to the growth side of the style box, the VictoryShares Free Cash Flow Growth ETF, GFLW, and the International Free Cash Flow Growth ETF, GRIN indexes uses free cash flow over return on invested capital rather than just growth in isolation. How does this approach differ from traditional growth funds, and why might it be more sustainable through different market cycles?
Yeah, it's important when looking at growth to consider that, the profitability of these businesses, right? Based on our research over the past 25 years, what we found is growth as a standalone investment factor hasn't been effective. It's only after you first account for profitability that we then see growth become effective over time. And so it's important to consider both of them in conjunction with one another. The way these indexes are designed to measure profitability is to look at free cash flow return on invested capital, which is a measure that tells you how effectively a company is able to convert its capital into free cash flow. The higher the rate they're able to do it, ultimately, the faster these businesses are able to grow. And so there's a direct link between this measure and a company's sustainable growth rate. The other thing to consider is, like with margins can be too limiting, right? They don't capture the full picture, right? They don't tell you how productive a business is. And so you can have companies where their margins are high, but they're constrained in their ability to grow because these businesses will require a lot of capital. And an example of this could be, or example where margins maybe are just too narrow, is in these streaming services companies. These are companies that are never going to generate the highest margins because their model is to pay royalties to content providers. What makes these businesses incredibly profitable is the fact that they oftentimes have large subscriber bases. And so if you're just looking at margins, you run the risk of missing out on opportunities like these companies that have really been a success story within the growth space.
For advisors who are already using high growth ETFs, what's so compelling about what they can get from Victory? What separates that?
Yeah, I think if we look at the market overall, we're trying to solve for two problems. Number one, the valuation, right? The idea that the S&P is at elevated valuations today. The way we're looking to solve for that is by looking at a metric like free cash flow yield. What free cash flow yield is going to do is it's going to make sure that you identify companies that are trading at attractive valuations relative to their free cash flows. And so that can be helpful in an environment like today where valuations are stretched. The other thing on the growth side of the box that you want to consider is this idea of market concentration and how a lot of these cap-weighted indexes are heavily concentrated in a handful of names. What we're saying to as investors is they should look to broaden out their exposure on the growth side of the market and maybe allocate to some of these companies that don't get as big of a representation in the growth index, but still represent attractive opportunities over time. And so broadening out, we think, is a way to reduce risk in the market as well.
Great. And then finally, we've definitely talked a lot about products today. Where can investors go if they're looking to get more information on anything we've talked about or find the prospectuses?
For additional information and a link to our prospectuses, please visit vcm.com.
Great. Thanks so much. And thank you for joining us at another episode of Just for Funds.